Hello, and welcome back to another episode of Darwin Investors. Today, we're going to be taking a good look at Dutch Bros. Every now and again, a company comes onto the market that creates a lot of energy, a little bit of buzz, and Dutch Bros certainly fits that bill. I will admit, in the interest of full disclosure, at the time I started to do fundamental analysis on this company, that I did own shares of Dutch Bros. And I'll let you know at the end of this video if I still own shares of Dutch Bros after doing all this fundamental analysis. So without further ado, let's get into this. So, like I said, Dutch Bros is a company that it creates a lot of energy and buzz because it's not just a drink company, it's a little bit more. And to me, it reminds me a little bit of, say, Chick-fil-A. So with Chick-fil-A, they don't make the best chicken. I mean, there are other competitors out there, Popeyes, KFC, that make a pretty comparable, brand of chicken. But you don't see lines wrapped around the building for Popeyes, and the reason why is because I would argue that Chick-fil-A is as much a customer service business as it is a chicken business. People also seem to be able to gravitate towards Chick-fil-A, almost like they've developed like a real loyalty. There's like a company ethos that a lot of people be able to gravitate towards. And so when I look at Dutch Bros, I was excited, same as I would if Chick-fil-A were to come public. I was excited to see something like this, something where people line up around the building. That there's a lot of loyalty here. People go from a long ways to get to one of these. You notice this guy here taking the order at the window. These people aren't driving up to a little metal box and barking into it and getting some coffee on the way out. There's a customer service element and a loyalty about this store that I found very exciting. It's something that I thought was kind of more akin to Chick-fil-A than, say, something like Starbucks. So Dutch Bros came public not all that long ago, and they have aspirations of getting up to like 4,000 locations. They currently don't have, they're only like in 11 states at the moment. So they got a little ways to go. They were coming on, they have about $18 to $20 for a share is what was projected to be their IPO price. They ended up IPOing at $23 a share. And by the time that retail investors like you and me were able to get our hands on it, it was $32 a share. And by the time it closed, it reached as high as $54 a share. And that's not surprising at all. I mean, anything that has this kind of energy it's going to create a higher share price. So we need to know whether or not that's a good price. The menu features a lineup of hot and cold espresso-based beverages, cold brew coffee products, tea, lemonade, smoothies, the proprietary Dutch Bros Blue Rebel energy drinks, and curates items from a secret menu. Secret menu being, I think that people can just go up to a Dutch Bros and custom order or custom make a drink of their choice based on the ingredients that they have. They also do serve some food products, but very, very limited. We're talking muffins and like maybe energy bars or something along those lines. This I found to be a little bit surprising. Most of their sales are captured between noon and 4 p.m. So 29% of their sales are between noon and 4 p.m. And now that makes sense, knowing that this Blue Rebel energy drink is their bread and butter. And most people are trying to stay awake after noon. So that would make sense that some of their higher octane type of coffees that they have, like the Annihilator, and some of these energy drinks are going to be sold more between noon and 4 than other times of day. And they do a fair amount of their business between 4 p.m. to 7 p.m. at night. So that was surprising to me. And then another thing is that the CEO points out that Dutch Bros has performed well alongside Starbucks, a fellow Northwest brand, for nearly 30 years. His guess is there's a Starbucks virtually everywhere the company exists, yet the brand has still thrived and found room for growth. And again, when I look at Starbucks and I look at Dutch Bros, I see two completely different companies. I see one in Dutch Bros, it has a very small footprint. Most of their stuff is drive-through. They don't serve that much coffee. I look at Starbucks is, yeah, it's a coffee company, but it's in as much as it's a coffee company, it's also an alternate work location. People go in there, they spend the day there, they buy whatever it is they have behind the glass and some coffees and get their work done during the day. So they have two different company type of philosophies. They're not really that similar. They share similarities, but they're not the same. So Dutch Bros right now has 471 stores in 11 states as of 30 June 2021. That was an uptick from just 6 years ago from 254 locations. I do see they have, if you look at their decades of growth here, they've able to go from 172 stores in 2011 all the way up to 503 stores currently, with 30 more stores on the way. You can see their expansion was pretty small, maybe 19, 20 stores a year at the beginning, and they've since accelerated that growth now. With accelerated growth and more stores and more revenue per store, you can see that their revenues are increasing in a linear fashion. However, their net income is taking a bit of a hit. Their net income was going up, and all of a sudden it's kind of taking a dive from 28 million down to 6 million net income. Now it's negative 117 million. So that's a concern. Why is this shrinking? It might have something to do with their IPO expenditures. I'm not sure what that's all about. They project that they're going to open 30 more stores in the fourth quarter. They're going to have revenue between $125 and $128 million. And they think that next year, they're going to grow at least 112 more stores. I also think that like Starbucks, they have a chance to basically license out their name. And, when you go to a grocery store and you see like these Starbucks products all over the shelves, I think Dutch Bros has the potential to do something like that as well. And what Starbucks does is they receive royalties from Nestle under Global Coffee Alliance in order for Nestle to put their products on their shelves. And that they file that revenue under other revenue on their balance sheet. Their single serve product activities to Nestle. So they file it under other revenues, and you can see last year for Starbucks, for instance, in of the $29 million or billion dollars this quarter, it was 1.7 billion was from licensing their name, and it was more than that even last year. So maybe as the license is expiring, or I don't know why, but they were making a pretty significant chunk of change from just licensing their name out and allowing other people to put their brands on the shelves. And that's something that I could see that Dutch Bros might be able to do at some point in the future. So let's go ahead and do an analysis. Let's break down what this company might actually be worth. So today they're trading at $46.47 a share, and they have 163 million shares. So that gives them a market cap of $7.6 billion. Now I'm going to project forward the numbers that they had actually projected in their own little presentation that they gave. And so we're going to say that they are going to convert on opening up 30 more stores. So they have 533 stores as of today. They're going to pull through on their revenue, and so they're going to have $484 million in revenue as a whole company. That gives them $909,000 of revenue per store. It gives them a price to sales of 15.67. If you look at their historic revenue per store, that's an increase. In 2018, they made $567,000 per store. In 2019, $741,000 per store. And in 2020, $888,000 per store. Their revenue is increasing, their per store revenue is increasing, but more modestly as of late. And so we're going to go ahead, when we do our numbers, we're going to leave it here at 909,000. We could shift a little bit up or down, but you're going to see that a little bit up or down really isn't going to matter that much. So as we said, last year they lost $89 billion in EBITDA, EBITDA being earnings before interest, taxes, depreciation, and amortization. But somehow their adjusted EBITDA was a gain of $68.8 million. And I attempted to try to understand this. So here's 9 months ended. Here's their EBITDA was $89 million lost. Their adjusted EBITDA, they had the gain of $68 million. They explained that EBITDA is basically the general account accepted accounting principles net income. And so that's the real number, but their adjusted EBITDA is a non-GAAP financial measure. And what they say that they're adjusted for equity-based compensation, expenses related to equity and other offerings, pandemic-related costs, and other non-recurring items as determined by management. So needless to say, I didn't know what any of that meant going forward, but luckily for me, the analysts at Charles Schwab are able to figure this sort of thing out. And what they figured out is that Dutch Bros makes no money earnings per share today. Their current PE ratio is non-existent, but they do have a forward PE of 236.70. So we know their forward PE. We know their price per share is $46.47. And from that, we can, using our math, we can figure out that their net income that Schwab analysts have projected will be $32 million next year. They're going to generate 19.6 cents per share. And so they're going to have a PE ratio that we already know that of 236.7. Now, in 2019, they had 370 stores, and they had a net income of $28 million a net income of $28 million total company-wide, which gave them a $75,000 in net income per store. And now what I projected is that eventually they'll be able to get there, let's say in 2024. But for now, let's go ahead and incrementally bring them up. Schwab had them at roughly 50,000 next year. I bumped them up to 65,000 in net income per store. Their stores, I said I would bump them up 110 a year, which is a pretty good clip, if you ask me. They're expanding from 11 states to 50 states, so I can see where they're going to put these things up pretty quickly. They do have a loyal customer base wherever they seem to open. People, they bring them in with open arms. They have a nice company ethos. They like to give back to the community. So they're one of these companies that people seem to be able to get behind. So I'm going to give them the benefit of the doubt that they're going to expand and they're going to do well. So the net income per store, I cranked it up to 65,000, not quite as good as it was in 2019, which gives them a net income of 49 million. So a price per share based on our current share price is 30 cents. And that would give us a PE ratio in 2023 of 154, which we know to be really high. We would ideally like for a growth company like this that we are seeing expanding like crazy, that's got a rabid fan base, that a lot of customer loyalty and a lot of growth ahead. I would like to see somewhere between 30 and 40 would be fine with me. And somewhere that also has potential to actually, like I said, expand into grocery stores. There's other opportunities for growth here. So I wouldn't mind paying between 30 and 40 for these guys. But 154 seems a bit steep. In 2024, we're saying that we're going to come back to the levels that they had in 2019, $75,000 in net income per store. And that gives them a total net income as a company of $64 million. And a PE ratio of 117. And then in 2025, again, they expand 110 stores. And we're saying that they're still doing 909,000 per store. That gives them a PE of 91.74. Now, I understand I'm just doing this 909. I'm not growing it year after year after year. But, even if I was to grow it, this number would still be really pretty big. But I am growing their per store net income. So I looked at a forward PE, like a fair value today, like what they would be worth, like if they had a 40 PE, and we're talking about a 40 PE in the year 2025, would mean that their share price today would be $20.26. And a 35 forward PE in 2025 would give them a share price of $17.72. So now we're right back at that $18 to $20 range that they were saying originally in their IPO. All that just to begin with. Now we do remember that they want to get to that 4,000 stores. So that's the goal, is 4,000 stores. So with 4,000 stores, let's say they make $1 million per store, because it's going to be a while before they get there. They have a 10 to 15 year time horizon to get this out there. So we're talking about 2032 to 2037. Okay, so 4,000 stores by somewhere in that range. There'd be $1 million per store, $4 billion in revenue, $400 million in net income, and at this current share price of $46.47. That would give you $2.45 a share, or a P/E ratio of 18.97. And I would say that at that point, they'd be a mature company, and that's a pretty fair share price. So what they're doing with this price here is they're pulling forward an awful lot of good news and a long, long way. So this is a very expensive stock. So what's it trading on? Why are people paying so much? Well, it's just fever, it's enthusiasm, it's buzz, but there's also a bit of fundamental analysis that goes along with this as well. So here's the 20-day moving average, and you can see the Dutch Bros briefly, when it like spiked because it broke above the 20-day moving average, and it just kept going. It was like hanging on there. It has now since dipped below the 20-day. So I would say that this stock, if it can't rise above the 20-day, is headed for a pretty good decline. Probably, gosh, maybe all the way down to, maybe back down to IPO price of like $34. I think that it's a great stock. It's one that I'm really interested in. It's a unique company. They're a great growth story. They have a lot of customer loyalty, but at this current price of $46.47, especially in this atmosphere that we're in right now, where value stocks are basically all you want to be in, certainly from now until like the middle to the end of summer. This isn't the sort of company that I would advise people to get into at this time. If they come down in price, and if the market sentiment, the mood of the market shifts in an upward direction, where these types of stocks, the ones that have kind of questionable price to earnings ratios and that sort of thing, come back into vogue, at that time you can get into it. But like, I would not suggest you get into this stock at this time. And I did end up selling all my shares, though I love the company. I love that they're growing fast. I love that they're profitable. I just don't love the price, and I don't like the overall mood of the market for a company like this right at this time. So for me, it's a sell. If you got anything out of this video, please like and subscribe and hit that little notification bell. And until next time, have a good day.